Sure. Yeah, I started in business back in 1973, right out of college, and started in banks, and then moved into pension fund management, and was portfolio manager for a Fortune 100 company, running their equity portfolio. Managed the active equity portfolio for a big insurance company. Was at Fidelity at one time. So my first half of my career was spent as an institutional money manager, mostly on the equity side. And then my second half of my career has been as a macro strategist. And so it's been a nice combination, having hands-on investing and having to perform, quarter to quarter. I think a lot of strategies just kind of come from the sell side, and being on the buy side for all that time has given me an edge. And I also coming in 1973, just prior to the Nifty 50 top and then subsequent bear market, taught me early on the value of being capital preservation oriented and understanding risk as well as reward. So all of that has really kind of shaped my career, and I really was macro from early on, and also contrarian from very early on. So
Okay.
it's been a nice combination. At least not everybody agrees with it, because when you're contrary, you can be off for a while, and people kind of wonder if you have any noggin up there at all. But it does pay dividends to be contrary to the consensus a lot of the time.
Well, if you've got a contrarian view, quite often when people turn around and they look back and they go, oh my goodness, I wish I'd listened. And speaking of which, you do tweet quite a lot about your views. And by the way, ladies and gentlemen, please go to David's official Twitter account, which is at Dave H. Contrarian, spell it the right way, because there's other ones out there that are pretending to be you, aren't they?
Yeah, thank you for mentioning that, because unfortunately, Twitter is loaded with people who, particularly if you have a lot of followers, and I've got 180 some odd thousand followers, these fake accounts like to take your profile picture and make it look like it's you, and then they'll change a letter in contrarian or some such thing, and it's easy to mistake it for me. Always look at the number of followers, because most of those fake accounts have 1,000 or less followers, or a couple thousand followers, and they really Twitter just is not taking them seriously. I think it's a shame.
Yeah.
I've probably blocked 40 of those fake accounts, and still get people saying, oh, was that you on Telegram? I go, I don't have a Telegram account. That's not me. If you see that, that's somebody trying to scam you.
Yeah, exactly. And David's not going to scam you. So I want to go into a tweet that you did on your official account on the 20th of May that said, we're at or near an important inflection point in many markets. Rates have topped, bonds look ready to run, and here's where it gets interesting. US dollar appears poised for a big reversal to the downside. Silver, gold, and the miners are beginning big runs to the upside, and the equity markets are bottoming and poised for a melt up. Well, that's the interview, ladies and gentlemen. No.
Yeah, you've got my view. You're all set.
Yeah, we're all set. We're done. No, but that encapsulates your thoughts. But what I wanted to talk about is when you say we're at or near an important inflection point, just expand on that for me, if you could.
Sure. As a contrarian, I think the times when I am most contrary are at what I call inflection points or reversal points. So when the market has a correction like it's had this first half of this year, it gets down to a level where sentiment is just so bearish that I think we're very close to a reversal point. And that's what I mean by inflection point. Right now, our sentiment is equal to what it was in March of 2020 at the bottom, pretty much equal to what it was in almost to where it was in March of 2009, certainly where it was at the bottom in 2016 and 2011. So at some of these very important turning points, what they always have in common is that most people are bearish. And we're at that point again where there's just an extreme amount of bearishness in the market. The reason sentiment works is because that means people have already acted on that sentiment. So they're already positioned bearishly. And so if you can find some sort of a trigger to reverse that, all those people on one side of the boat have to shift to the other side, and you get a pretty good rally. So that's true in the equity markets right now. It's also true in the bond market. And again, I'm not talking about in the next day or next week, but it looks like we topped out in bonds, 10-year at 316. Got down to wherever it got down to 275 maybe, and it's bounced back up to 290. And the 30 years from 3.25 has come down under 3. So it looks like the rates have reached their peak and are rolling over. The dollar, as you say, got up to something over 104. I certainly didn't expect that strength. I didn't expect it to retrace back to the highs of a couple of years ago, but it did. And it made new highs and now appears, in my opinion, to have peaked and is starting to roll over. So all of those things, and then, of course, gold and silver have been basically, they had their nice run coming out of the March 2020 low, ran to August 2020, big runs. And I thought we'd, have a sideways to down consolidation for a few months, maybe, 4 or 5. And instead, we've had a 18-month or more consolidation. And they are, they bottomed earlier this year, and they've just been kind of slow to really move out from under that. And I think they're ready. I think they're poised for big moves. We can talk about that later, but that's what I really mean is it's amazing to have so many markets at either reversal points to the upside or reversal points to the downside. The dollar being down, rates being down, gold, silver, equities, and bonds being up. And I think they're all going to pretty much be coincident in terms of their rallies this summer, or rallies or sell-offs.
David, there's a lot of, again, you're talking about the rally, but you're also going to be talking about a crash. We'll come to that in a minute. But as you and I speak today, there's a lot of talk of inflation no longer being transitory, prices are going up, supply chain restrictions, global markets in a little bit of turmoil, China shutting large swathes of the country down. What impact do you think that that's going to have on market sentiment? And is that here to stay, or where do you see that going?
Yeah, it's interesting. I have to say, I'm calling for a melt up to 6,000 on the S&P, 20,000 on the NASDAQ, 45,000 on the Dow, 3,000 on the Russell 2000. So these are big runs from the lows of March 20 when I sent out that tweet, and that was the low in the equity market, at least to date. Those are, 50, 60, in NASDAQ's case, I think an 80% run from the low to my target. And I'm talking about seeing those peaks this year and probably in the next 3 to 6 months. That's insane. So I get it when people look and see a Fed that looks like it's going to have to hike rates and is indicating that it plans to hike rates for a good long time, that it's just beginning QT to shrink the balance sheet, that inflation's a lot. There's a huge spread between the inflation rate and the Fed funds rate or any of the Treasury bond rates. It's hard for anybody to wrap their arms around why would somebody be calling for what looks like it may be the biggest rally in history, biggest, steepest rally in history, at a time when the Fed's clearly indicating they plan to tighten a lot more, they plan to fight inflation, and they've come out and said, we don't really care what it does to the stock market. We're no longer your savior. There's no Fed put. We plan on pushing stocks down to dampen wealth and hopefully take some of the air out of inflation. And I get all of that. I'm not making my forecast blindly, but I think what people are missing is how much of the tightening has already taken place, which means the bond market, when you had the spike in rates earlier this year where, the 2-year went from, I don't know where it was, 1.25 up to, 2 2.75, and the 10-year went from 120 up to 316. You had more than 200 basis point hikes in these rates because the market was ahead of the Fed. The Fed dragged their feet, but the market didn't. The market saw the inflation and reacted. Those big changes, rapid changes in rates, even though they're still relatively low historically, to raise rates so quickly, so dramatically, has had an impact on consumer spending.
Yep.
It's had an impact on housing. And I think when you look at the inventory levels at places like Target and Walmart and some of the other inventory numbers coming out of the retail sector, we're in for a good old-fashioned inventory correction. And inventory correction is, in at least when I went to school, is basically a definition of what a recession is. You have to correct those inventories. When they stop ordering and work down those inventories, that means it moves back through the production end, and you stop producing because you're not getting the orders. So manufacturing takes a hit. That's how an economy slows down. The Fed's thinking the economy's strong, inflation's strong, and they think they have to hike rates. They've already said 7 times this year, maybe 7 times next year. They're not going to get close to that. I'll be surprised if they get beyond July. You got a 50 basis point hike pretty much baked in the cake for June. They claim 50 in July. I think by then it's going to be pretty clear that they've already done a lot of damage. And Fed record is not good on soft landings. They say they want a soft landing. If you look at history of Fed tightenings, they have caused every recession. And we know from what happened in 2008-9, it was a pretty dramatic so-called Great Recession. They always go too far and don't anticipate the damage they've done. And I put it very simply, it's because they don't understand the leads and lags to policy. So they're judging when to stop policy by data points. So they look like today a manufacturing number came out, a PMI manufacturing number came out, and it was higher, went 56 and up from 54 or something like that. So it looks like manufacturing is still relatively robust.
Yeah.
Yeah, but if you're an economist, you should be looking at the things that lead to what's coming down the road and saying, oh my goodness, inventories are up, housing's starting to roll over. Maybe we need to worry that we've gone too far already. They're not of that mindset yet. But I think in the next couple months, data is going to be weak enough that they may wake up to the fact that at the very least, we need to pause.
And that's interesting. That I like the analogy. I understand it. But David Hunter, you're saying there's a melt up coming. So you're talking about we could be here. There's tightening. They've gone too far. We might be in recession. These are all sort of negative to me on one hand, and then you're saying there's going to be this massive melt up, which, by the way, ladies and gentlemen, is a very rare event. It's not something I think most people think of a melt up as being, a few hundred up on the Dow. No. Melt up is parabolic shift. If it's all that sort of negative side of things, how do we get a melt up in those conditions?
Yeah, because markets look over troughs. And so keep in mind, we've had a lot of concern and talk about Fed tightening for almost a year. It really started last June, where there was concern that the Fed was going to have to tighten because inflation was starting to lift its ugly head. And so we had discussion about tightening all the way through last summer and into last fall. And obviously until, Powell got religion in January, he was talking about transitory inflation, but there was always concern on Wall Street that the Fed was ultimately going to have to deal with that inflation and tighten. So that's been a concern for the markets for the last 12 months. If by the time we get to the July Fed meeting, the economy is weak enough that the Fed can, says maybe we need to pause. We don't want to, create a hard landing. Let's at least sit quiet for this meeting or next, after we make this hike, let's not do anything for the next couple months. If they do that, that switches a very stiff headwind that's been holding the market down, certainly this year, into a tailwind. It doesn't mean the Fed's all of a sudden going from QT to QE. It doesn't mean the Fed's all of a sudden going to cut rates, but just sitting on their hands and saying, okay, we're going to watch for a little while to see what we do next. That will be a big switch from, oh my God, the Fed's just starting tightening and there's a lot of tightening to come, right? So I think it's mostly a change in mindset. And keep in mind, this market move isn't going to wait for the Fed. The bond market led on the tightening side, right? They started tightening in early January, and rates went up all through the first 5 months, 4.5 months. I think the same is true here, where I expect the 10-year to drop below 250, maybe even below 2.25 in the next 2 or 3 months. So the rates are going to be coming down before the Fed does anything. So it's really, and that's what if you follow me at all, you've seen me talk about the street narrative, the street tightening narrative. Yeah. That's what I mean by that. Market expectations will turn before the Fed turns.
You as a contrarian, you've also commented on oil prices. Now, here in Australia, that's all they're talking about at the moment, David. They're talking about fuel prices and cost of living, because this is Australia. People have to travel quite a lot. They use their cars like they do in the US. You're saying that next year you would see the oil price could collapse, should I use the word collapse, down to around 30 USD a barrel. What are you thinking, David?
Yeah, so I did put out a tweet this week with that forecast of saying I think we're at or near a peak in oil, and that whether it turns today, tomorrow, or whether it's still a couple weeks out, we're pretty close to the top in oil for the cycle, and that it will fall eventually to $20 in the global bust next year. Now, of course, people hear peaking oil and see a $20 forecast and they think I'm talking about $20 in the next 3 months. I'm not. It will gravitate to that level, with most of the damage done to the oil price happening probably beginning late this year and all through next year. So, but I do think we're at a peak and could be under $100 during the next few months. And so the reason, the simple reason for it is that I'm forecasting first a recession to start. We may be in it now, or we're getting closer to it. As I said, demand's falling, et cetera, inventory corrections coming. So the first thing is we're heading for a recession this year. I think that's going to morph into a global bust next year. And global bust, by my definition, when I say bust, and it's another term I used before anybody else was using it, and now it's everywhere. But my definition of a global bust is the worst global downturn in the post-World War II era. So essentially the worst global downturn since the Great Depression. So worse than 2008-9, and accompanied by, I think, the largest financial crisis in history. So I'm talking about something worse than 2008-9 for sure. Mm-hmm. And I think it's that demand destruction that comes from, again, the terms get thrown around and people hear global bust and they may think he's talking about another recession or whatever. It's something that's going to really hit demand hard, because across the board in all kinds of industries and sectors, we're going to have a very bad economy, and it's going to hit demand, not just consumer demand. It's demand at the industrial level. They use a lot of oil. They're not going to be needing nearly as much oil if they're not producing at that level. It's all the way across the board globally. Demand's going to be down sharply. And I think supply could follow. There's been tight supply, but I think you could see some of that eased up too. But I don't need that. I'm really looking at the demand side. So, like I said, it's not like that all has to happen this summer. It's really more the bulk of the decline, let's say from $80 to 30 or $70 to 30, will happen during next year's, the worst of the economy. But from $120 down to 70 or 80 in the next 6 months, that's a big decline. And I think that's possible. It might take its time starting. We'll see. But let's say, and again, this is a hypothetical, I don't have a lot of conviction, but let's say oil drops below $100 and gasoline starts rolling over at the same time that the Fed recognizes, let's say midsummer, that the economy's slowing down more than they expected, far more than they thought. That oil coming down to that level, let's say it's $90 or $80, that takes some of the inflation fear away. They can then be focused on the economy more and say, yeah, well, I think maybe we've conquered at least some of the inflation, and maybe we need to focus a little bit on making sure we engineer a soft landing, not a hard landing. So I think all that could be where we're at 3 months from now. And like I said, the markets will lead that.
David, give me a bigger picture, if you like, because we started this conversation by talking about the melt up. We've spoken about the bust. What I would love is the bigger picture, because people are concerned at the moment. There is volatility. Markets go, the volatility is crazy at the moment, and people are, I guess, confused. So what would you say to people that are heavily invested in the share market? Maybe they're invested in the property market. How do they protect their wealth in these incredibly volatile times?
I'm a macro strategist, which means I cannot make recommendations or provide advice. I can forecast the cycles, I can forecast the market, forecast the economy, but I can't provide advice. But what I can say is that my melt up forecast, which is calling for, you can do the math, but from 4,000 to 6,000 is a 50% move. And I think it happens in 3 to 6 months, and NASDAQ even bigger move. Don't take that as me saying this is a carte blanche recommendation. Go in
absolutely
with
not
both feet and buy, because what you have to look at is that it's the end of a 40-year secular bull market. I'm saying that the bull market, equity bull market, started in August of 1982. That's rather controversial. Not everybody agrees with that. A lot of people think it started in 2000, post 2000, 2003, or even 2009. But I think it started in 1982. I date it there because that's when disinflation really began. We had the hyperinflation of the early 80s, and inflation was 20%. The Fed with Paul Volcker started working on it, and it started ratcheting down through many cycles. That reduction in inflation from 20% ultimately down to virtually zero, and the interest rates from 21% T-bills down to virtually zero, and 10-year from 15% down to a quarter or 40 basis points. That all took place over 40 years, and the PE multiples were the inverse of what rates did. So if rates came down, PE multiples expanded from single digits to mid-20s. That's where we got this huge bull market from. So I date it back to when that started. And I'm saying that we are in 2022 going to top that 40-year cycle out. So we are in the very last stage of this 40-year run. That means you have to, as an investor, be aware that, number one, I can be wrong for sure. And number two, you're in the last few months of something that's been going on for 40 years. I'm not endorsing anything. I'm just forecasting. I'm just saying this is what I think the market's going to do. So people need to work with their financial advisors and
absolutely, this is what
understand risk and reward, because there's too often investors focus on the reward and don't understand the risk profile that goes with that. So and I'm, as you have already mentioned, And I'm calling for a global bust to follow this melt up, accompanied by an 80% bear market. So yes, you've got a big run up to a top, but soon thereafter, you're going to be looking at the biggest bear market since the 1929 crash. So at least if I'm right, the risks even now are very high. So the reward is high if you catch this right. But boy, if I'm wrong or if you catch it wrong, there's a long way down on the other side of this mountain.
Well, one of the things we talk about often in conversations with people is diversification. And I love precious metals as a potential way to, I guess, have that sort of hedge or that insurance. Recently, I guess back in March, you were saying gold to 2,500. You've recently revised that, saying that you see the gold price reacting up to 3,000, silver to $50. Give us your macro view on precious metals and why people should be having a look at it, because right now it's a very unloved sector, isn't it?
It sure is. Yeah, it's. I think it is the most undervalued sector of any asset in any of the markets. It's just lagged behind for so long. Amazingly, I always said the thing that drives gold and silver is inflation, and we've had that in spades this year, and yet it's done very little. It did start to move early in the year, and then the strong dollar kind of killed it, I think, and it went back, retested, and it's just slowly coming out of its slumber. And I think it's been a long slumber. It really had a great run in 2020. And then from August 2020 to now has just done nothing. But if you step back and look at a big picture, and I don't always talk technicals, but if you look at a big, long chart, there's an enormous flag formation that should be exited vertically to the upside. So if that's right, I think gold can go to 3,000. Maybe by the end of this year, could spill over into next year, but I think certainly could happen in the next 6-7 months. Silver, as you say, I'm calling for 50. It's currently, just under 22. Once it gets up above 30, I think you're going to have a pretty good run. So it's been kind of bouncing between the low 20s and 30 for quite some time. Again, there's a flag formation there that I think once it gets out of, you'll see some clear sailing. So I think commodities will play in this melt up, and I think the precious metals will be part of that. So